Greetings. My name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks Associates Wealth Management. Today is Thursday, March 9th, 2023, and this is our monthly market monologue. And before we launch into a review of the economic climate, as well as a review of the stock market from last month and year to date, I want to stop and give a quick practice update. And first of all, congratulate Karen. She's been with us now for 1 year and has taken over the practice manager role. And for those of you who have been with us for any length of time, know that Athea has kind of transitioned into a quasi-retirement. She is working part-time from home, serving me in some, you can call it an executive assistant fashion. And if you have her email address, I'm sure she would welcome a congratulatory note to her as well. That said, we got a couple of questions from a couple different clients recently that occurred to us that many of you might be asking the same questions. So the first one was, is the trade volume that this client saw last year typical? And should we expect that moving forward? And the follow-up question from a different client was, what are we going to do? Effectively, the second client was asking, we've been in a difficult environment, what are we going to do moving forward? And the reality is the two questions are correlated. In our portfolios, when we are managing money for our clients, we are operating in a transaction cost environment. We are fee-based, and the fee covers those trading costs. So there are no costs when we buy or when we sell a position in our model portfolios. That said, that drives the answer to the second question. We cannot predict what the market is going to do on any given day. And we certainly cannot predict what the market is going to do over a longer time period. And so what's important to the vast majority of our clients is to protect on the downside. Most of our clients over the years have told us they would rather give up some of the upside if it means protecting them more on the downside. So that's what we focus on. We focus on managing risk and reducing drawdowns. And so if a position that we buy moves against us, we have a tendency to give it a little bit of wiggle room, but not much, because we don't want a small loss to turn into a big loss. And if you stay tuned to this channel, hopefully next week I'll produce another video that will discuss this in greater detail. And that video will be, I think it's going to be called Portfolio Math. So stay tuned for that. But hopefully that answers those two questions. So let's move on. The next thing I want to mention is I've been invited to address an organization here locally. It's a headhunter staffing agency called Reagan Madison. They're going to be hosting a continuing education webinar for their clients, and they've invited me to speak and give an economic update. If you would like to join Reagan Madison for that event, I will put the registration link in the comments section. You are more than welcome to join us. That said, let's go ahead and start reviewing the stock market. For the month of February, the S&P 500 was negative 2.6%. On the screen is our seasonality chart, and this is showing us the average monthly performance since 1950, and we can see that the average February is indeed negative, but it's only negative 0.6 on average. Well, 2023, we would have been off the chart. So February was indeed very tough, and it was tough just about all the world around. On the screen now, we're showing the NASDAQ index was negative 1.1, the S&P 500 again negative 2.6, and then here we have the 20-year Treasury bond ETF negative 5%. The point that we want to make here is that this high degree of correlation between stocks and bonds has been continuing. And typically speaking, we expect some lower degree of correlation. So if stocks are up, sometimes bonds are down. But if stocks are down, sometimes bonds are up. That has not been true for the better part of a year. And unfortunately, that trend has remained. So as the stock market rallied in January, the bonds were also rallying, which, hey, that's good news. But in February, when one corrected, they both corrected. And this makes it difficult to have a quote-unquote diversified portfolio, because when most people are diversifying, they're diversifying asset classes and putting bonds in their portfolio because it's supposed to be a portfolio stabilizer. That has not been true, and so far it's not true this year either. When we diversify, just so you know, we're diversifying across strategies, not necessarily asset classes. Again, if you have any questions on that and what that means, let me or my team know. We're happy to answer in more depth for you, especially those of you who are not clients. If you're clients, hopefully you know by now what that means. That said, let's move on. So here's the S&P 500 on a monthly candle chart. And one of the things that we've been talking about is the importance of this 4,100 level on the S&P 500. When we look on a monthly chart, we can kind of see why it is so important. And this is the current month. March has already started when I'm recording this. So this is March. We're talking about February. And you can see that we breached that 4,100 level, but we came right back in. Now, what we're going to see on a daily chart, here's the daily chart for the entire, this is 2022 over here is when 2022 started. And then we see February starts here. Actually, February started right here. And then that's the last day of February. So let's zoom in just to make it a little bit easier for you to see. And what we want to highlight here is that when the S&P rallied in January, it breached this 4,100 level, but really only for a little bit of time. Then it really struggled to maintain that and it broke down. The good news is that when the S&P 500 broke down in February, it ultimately tested this black line, which is the 200-day moving average. We talk a lot about that moving average. The other thing that we point out is if you look left to right, you see the black line, this 200-day moving average, is clearly in a downtrend. The good news is because of this rally, the 200-day moving average is beginning to level out. But so far, the 200-day moving average has served as support. So as I'm recording this on Thursday, the 9th of February, right now it's about 10:45 in the morning, and the market is indeed trading up just a little bit. But before moving forward, what we're trying to highlight is the fact that this pullback of approximately 6%, it is indeed healthy. Pullbacks like this are very, very natural. When you have a rally, the market typically pulls back a little bit. However, in the environment that we are coming out of, and to some extent are still in, it is indeed appropriate to remain cautious, especially when you have the constant conversation about a recession that is approaching. And we're going to talk a little bit about that in just a minute. Moving on now, on the screen we have the NASDAQ composite for the monthly candle chart. And again, this most recent candle is the month of March, which is obviously still going on because today is March 9th. But this is the month of February, and you can see this extreme volatility for the NASDAQ. It started the month here at the top of this black box, rallied all the way to the top, and then closed lower. On the daily candle chart, again, on the screen is the full year from 2022 through through yesterday's trading. And zooming in a little bit, we can see that February started with this very bullish start to the month of February, gapped up. We had a nice day on February 2nd, and that was the short-term high. So what you're going to see is February 2nd on both the NASDAQ and the S&P 500 was the short-term high. So we're going to switch gears and start reviewing some of the economic data. And by now, you have no doubt heard from many that a recession is coming in 2023. That's where we're going to start by looking at some of the articles that we've compiled from various sources talking about this recession in 2023. We're going to start by looking at a post from Bloomberg. And in particular, I want you to notice the date of October 17th. Okay, and look at that title. Forecast for U.S. recession within a year hits 100%. Now, that's pretty declarative. Look at the date, October 17th. What I want you to notice is this big tall candle right here. This is so far the low. This is October 13th, which was a Thursday. Then you've got the 14th, and then this date right here is the 17th. This is when Bloomberg is declaring that a recession is 100% certain to happen in the next year. Well, what's happened since then? Here we have another article from Bloomberg. This is now, they're saying there's placing a 70% chance for a recession in 2023. They posted this on December 20th. So it seems like they've come down in their estimates. Now we've got bankrate.com. And again, they're declaring this. The U.S. economy has a 64% chance of entering recession. This date is January 4th. And now that we've got the Wall Street Journal declaring on January 15th that the economists still see a recession coming despite easing inflation. Here's another one from the AP dated February 27th. Now, what we're starting to see is some of these economists and the consensus view is beginning to change their opinion. And I would argue that is because of what we're seeing in the stock market, especially in the month of January. When the market is rallying like that, the stock market is a leading economic indicator. And if the stock market is going up, the stock market is not forecasting a recession. Remember, we've talked about this multiple times, that by historical standards, the stock market does not bottom before a recession starts. So if a recession is coming, then we need to be on guard and very, very defensive in our investment allocations. But the stock market's rallying. And what you're seeing is all of the economists are starting to change their tune. Now, this is the conference board. And again, conference board, March 5th is the date of this, and they're still declaring that almost 100% certainty of a recession that's coming. Or is it? Now we're going to look at the Federal Reserve Bank of Atlanta. We've talked about their Fed Now chart. And you can find this online. Just Google Federal Reserve Bank of Atlanta or Fed Now, Fed GDP Now, and you'll find it. And this is as of yesterday. And Fed Now, the Atlanta Federal Reserve, is estimating that first quarter GDP growth is going to be 2%. That, I want you to notice, is well above, or I guess just a little bit above, some of the consensus. The blue chip consensus estimate is right in here. What is that, 0.5%? But the Atlanta Federal Reserve believes the first quarter GDP is going to come in at a positive 2%. That's not recessionary. So I mentioned that the stock market is a leading economic indicator. And if the stock market is rallying, that is suggesting that a recession is not coming. But we also talked about the fact that the S&P 500 had a pretty negative month for this past month of February. Nothing in any of our analysis is going to tell us definitively what's going to happen. I will mention before moving on from this seasonality chart that history suggests that this positive month of March tends to start around March 15th, plus or minus. Well, that's next week. So we'll see what happens. Underneath the surface, these are the various sectors of the S&P 500. We can see that the technology sector technically eked out a gain for the month of February, but everything else was pretty negative, with energy, which was the star of 2022, negative 7% for the month of February. Now we're going to look at some what we call breadth measures. And again, in the top pane is the S&P 500, and then we have the percentage of the S&P 500 that's above the 20-day moving average, the 50-day moving average, and the 200-day moving average. For those of you who are new to our channel, 20-day moving average is approximately 1 month. 50-day moving average is approximately 2 months, and the 200-day moving average is approximately 9 months. And it is usually the 200-day moving average that we're looking at to help us to determine if the stock market is in an uptrend or a downtrend. So again, we see February has come in, and we look down here, we see the percentage of stocks in the S&P 500 that are above the 200-day moving average has definitely come down. As of yesterday, we're still at about 54%. So about 54% as of yesterday, about 54% of the S&P 500 is still trading above the 200-day moving average. So that's healthy, but it's definitely getting a little bit weaker. The other concerning news is what we refer to as the advanced decline line. We talked about this in last month, so I won't bore you with all the details, but one of the things that we were looking at is the fact that the S&P 500 was flat just from this peak in looks like late November to the end of January. That's fairly flat. Obviously, it went down, but it rallied. But the advanced decline line was rallying much stronger. So that was what we refer to as kind of a bullish divergence. It's telling us that even though the stock market, as measured by the broad index, has not rallied strong, there's a lot of strength underneath the surface. So that was a good sign. Unfortunately, as the S&P 500 has come in, so has this advanced decline line. So that's telling us that unfortunately more stocks are declining than are rallying. We'll see if that is going to change. Obviously, this is one of the things that we look at on a fairly regular basis. In other concerning news is the yield curve. We've talked about this ad nauseum. This is the 10-year yield minus the 3-month yield. And we can see that it did correct up to the positive, but it has since come right back down, especially after Chairman Powell made his comments on Tuesday and Wednesday. Next, we're going to land the plane here in just a minute. I want to look at the actual GDP statistics, and in particular, I want to zoom in, if you will, on 2022. First and second quarter, we had negative GDP for 2 quarters in a row. And by many historical standards, 2 consecutive quarters of GDP decline would indicate a recession. However, the National Bureau of Economic Research and others stated last year emphatically that a recession is when we have significant economic contraction, and they did not believe that last year's barely negative GDP would count as a significant GDP contraction. Well, where are we at now? Again, this is from Conference Board. And again, you see the 2022 first quarter was negative 1.6 and the second quarter is negative 0.6. According to Conference Board, their estimates are negative 0.6 for the first quarter. Remember, we said the Atlanta Fed now, or Atlanta GDP now, is forecasting 2% GDP growth. That disagrees with the Conference Board. So we have negative 0.6 according to Conference Board, then negative 2, then negative 0.7. Well, many would say that if these numbers from last year were not significant economic contractions, are these significant economic contractions? So we remain skeptical that we are going to see a recession in 2023. And as a reminder, we do not make predictions. Because of what I mentioned earlier, the fact that there are no trading costs when we are trading in our models on behalf of our clients, we can be very active if we believe we are in an environment that dictates that. And this is certainly one of those environments where there's a lot of estimates out there that we're going to see economic contractions and it's a difficult economic environment, etc. Well, that dictates certain changes to an investment portfolio. We want to be participating when the stock market's going up. We don't necessarily want to be participating when the stock market's going down. But when we look at these estimates, we don't know what's going to happen. And today was a perfect example of that. When I started shooting this video this morning, right after the market had opened, the market was trading up just a little bit. Not much, but it was positive. That is not how the day ended. This is the S&P 500. This is one of the S&P 500 ETFs, and you can see that today was a very negative day. Now, if you want to look for the silver lining in this, we can see that the market closed right about at the 200-day moving average. So maybe the 200-day moving average will once again serve as support. I don't know. But in particular, I'd like to highlight the fact that when we are shooting this video, the market opens here, we're relatively flat, and then right about lunchtime, the market just starts cascading down. And this illustrates what we were talking about a few minutes ago. Clients asking, what are we going to do? We're going to focus on managing risk. Because we are in a very volatile environment and a very challenging economic environment where we might have a recession. We might not have a recession. The markets might go up. The markets might not go up. But the reality is when we're managing money for our clients, we're going to focus on managing the downside risk. And if the markets are moving against us, well, we want to protect clients as much as we possibly can. We cannot prevent losses. That's not possible. I can't control the market. Neither can anybody else on my team. But we believe strongly that our clients, as I said earlier, are more interested in protecting on the downside than they are in getting all of the gains on the upside. So I hope that helps. Stay tuned to the channel. We will, as I said earlier, publish another video probably next week that I'll call Portfolio Math that will hopefully help explain some of this stuff a little bit more. And if you have any questions, by all means, feel free to reach out to me or any member of my team. It's an honor to serve you. And we look forward to chatting with you again soon. Feel free to reach out to us. Also, if you're not a client, we would be happy to see if we can be of service to you. Thanks for watching.